Hello everybody, my name is Ryan Bundy. I'm a mortgage loan officer. We put out a bunch of educational videos on how to make really good decisions. Unfortunately, in our industry, there's not a lot of guidance on the finance side of things. There's a lot of just quotes. Here's your quote, and hopefully you take it. They don't explain it, but we're here to tell you that there is a very good way to structure your loan that's gonna save you a ton of money. And so we're gonna talk today about rate buy down. Super important. We're seeing a ton of it in this market since rates are elevated from the last 13 years. Actually, the last 2 years have been elevated, but before that for 13 years, rates were so low that nobody was really buying the rate down. And now it's super common and there's a good strategy to this. So super important that you're getting good guidance. If you're not getting good guidance from your lender, start interviewing other lenders, okay? Because you're gonna lose thousands of dollars if you make the wrong decision. Okay, so what we're gonna do is we're gonna talk about three things. We're gonna talk about what a rate buy down is, and I'll do the best I can. If you have any questions, just pop them into the comments below and we'll try to reiterate what we just talked about. But we're gonna talk about what a rate buy down even means. Most people don't truly understand how it works. The second topic we're gonna talk about is why would you buy the rate down? Does it even make sense? A lot of times it doesn't, okay? So like I said, what I'm seeing is a lot of people just quote, they don't explain it. Low rate gets you all your eyes this big, but they don't really, they don't pay attention to the huge fees that are associated with a buy down. Thirdly is I'm gonna talk about a good strategy, maybe just a balanced approach, and I'll give you my opinion on rate buy downs. Everybody's a little bit different. There's a subjective side and an objective side of rate buy downs and how to look at this, okay? So let's talk about what a rate buy down is. A rate buy down just means you're buying a rate lower than the market rate. So let's say rates are 6.5%, right? If you wanted to buy the rate to 6.25, there's gonna be a cost for that. If you're buy down to 6%, 5.875, the costs are gonna get bigger and bigger and bigger as you go lower, right? So you're just paying a fee at closing for a lower than market interest rate. The amount of money that you're paying are called points or discount points. So when you see a loan estimate, it should say discount points. That is the fee associated with the certain interest rate you're being quoted. Another thing to be real careful about and understand is that rate buy downs are not linear. So it's not a certain fee between 6.5 and 6.25, for example. It's market based, and rates usually work in 1/8 of a point increments. So 6.5, 6.375, 6.25, etc. right down the line. There's no linear fee increase. It's really literally market based. So each rate on a daily basis is gonna have kind of like a stock ticker next to it that fluctuates, and it's a percentage of your loan amount. So if you have a $500,000 loan, you take that little percentage mark that fluctuates with the market like a stock ticker, and you times it by 500,000. That gives you a dollar amount. So for example, let's make it super easy. If you want to buy the rate down to 6.25 and it's gonna cost you 1 point, which is 1% of your loan amount, that would be $5,000. A lot of money in closing costs. So these are things you want to be advised on, so you're just saving the most amount of money to meet your goals. Another thing I want to talk about here is how do you get that paid? Well, you can pay it out of your pocket, or you can ask the seller to pay it, all right? So keep that in mind when you're negotiating. If you want to buy the rate down, ask your realtor to negotiate for the seller to help you pay closing costs. All right, the second topic is why would you want to buy the rate down? Like, what is the benefit for you? So the benefit is that you're going to get a lower payment with a lower interest rate. Now on the flip side, you're gonna have more cost out of pocket. So when I talk to somebody, the first questions I ask them when I first meet with them on a loan consultation is, what is your monthly payment budget? They give that number to me. What is your cash to close budget? That means down payment, closing costs, buying the rate down, everything, okay? So once I have those numbers, sometimes I have to buy the rate down to meet this payment goal. Sometimes, they don't need to buy the rate down to meet their payment goals. So sometimes it's better to have a higher interest rate and just balance that out. Now let's talk about why you would not want to buy the rate down. There's several different factors. So especially in this market when we're entering or been in a higher rate environment than we were the previous 13 years, is that some people think that rates are going to drop. Nobody knows what's gonna happen. Keep that in mind. No matter what anybody says, nobody really knows. But the fact is that a lot of people think they're going to refinance out of this loan. If you're one of those people who think you're not gonna keep this loan very long, whether you're gonna move, you're gonna refinance, you're gonna pay the loan down faster, you're gonna go to a 15-year, refinance into a 15-year and save interest, then you do not wanna buy the rate down too much. You wanna balance it. We'll talk about that in the strategy, but you do not want to buy the rate down. You'd rather take a higher rate since you're not gonna have that loan that long and not pay all this money up front because it's non-refundable. Once you buy the rate down and you pay the money at closing, the money's gone. So We'll talk a little bit about break-evens on strategy, but those are reasons why you would want to buy the rate down and why you would not buy the rate down. Okay, let's talk a little bit about strategy and why you would want to buy the rate down for you in a specific situation. So let's take an example. Let's just say that you're gonna stay in this house for 10 years. You don't need to upgrade. Your kids are a little bit grown up or maybe even out of the house where you're like, hey, I'm done. I'm gonna keep this mortgage a long time. Don't plan on moving, all that stuff. So that's when you would wanna consider a bigger buy down, get the lowest rate you possibly can. We can do a calculation to show you, hey, if you're putting $10,000 up front to get a 5.75 rate, it's gonna take you X amount of time to recover this money. And then after that time, it's pure savings from then on. I have spreadsheets that literally show you, what makes the most sense. If you're going to not have this house and you're going to refinance, it's super important to balance your points, your buy down and your rate to make sure that your break even is probably 1 to 2 years max, I would say, even closer to 1. So what I'm seeing a lot right now is people take a higher interest rate, that par interest rate with no buy down. It makes sense for them to take a higher interest rate, no cost to them, and there's no risk. So when they refinance, it's like free money and they don't lose all that money that they put up front. So if you're in that camp, keep that in mind. And if your lender sends you something that just shows a lower interest rate and just a bunch of high fees and you don't understand it, they're not advising you. They either don't care, they don't understand how to explain it, or they're not a professional. So I would just watch that very closely if you're not getting a full consultation. It's super important to strategize this. I'm seeing people make decisions that lost them $10,000, $15,000 on their points because it did not make sense to do. So if you have any questions and you like this information, you can like this, you can subscribe, help us out. We're building this channel. We want to put out authentic mortgage education. Okay, thank you.